Well, welcome back to Finance Uncut. On today's episode, Basel III equals $855 silver. Game on. So those of you that follow my channel will know earlier this year I did a video called Basel III equals $855 silver, where I explained what Basel III was all about. And the $855 silver was not my price target, but someone else's price target that we discussed in the video. So if you haven't yet watched it, I'll put a link in the description below. Since then, I've done a Basel III update video where we discussed how the UK regulator gave an exemption to the LBMA, or so we thought. But in this video, I've been following two people that I follow. They're absolute silver gurus, gold and silver gurus, and I highly recommend you follow them as well, is Andrew Maguire and Alasdair Macleod. Now, in this video, I'm going to show you where they argue that actually Basel III is still game on. So that the bullion banks, or the LBMA, is actually going to become a clearinghouse, and that we are going to see a massive reduction of paper derivatives. So, and also, what the heck does the World Economic Forum have anything to do with this? So before we cut to a video with Andrew Maguire, let's just have a look at this article on goldmoney.com by Alasdair Macleod, dated the 15th of July, titled LBMA Gets a Lifeline. Now, I'll put a link in the description below and you can read it, the whole article in your own time. The draft PRA rules complying with Basel III regulations have now been issued 6 months ahead of their implementation to allow banks to adjust for them in time. From now, senior bankers, their lawyers, and bank treasury managers will be planning amendments to their business strategies accordingly. As a division of the Bank of England, the Prudential Regulation Authority recognises the importance of gold trading in London and has inserted a clause into the new rules, which will allow the LBMA's centralised settlement system to continue to function, but in line with Basel III's apparent determination to get banking's exposure to uneven derivative positions substantially reduced net positions in precious metal derivatives in the form of forwards and swaps will be penalised through the inefficient use of balance sheet resources and will likely be replaced by transactions fully backed by physical gold. The LBMA has been thrown a lifeline, but will likely have to focus from forward derivatives to physical bullion-backed trading. By responding positively to these developments, the LBMA and its membership can retain and build on their preeminent position in global precious metals markets. This article points out that the market value of forward derivatives in gold is currently equivalent to 8,675 tons. While it would be incorrect to think it will all translate into new bullion demand, there is little doubt that if Basel III leads to the demise of the London forwards market, it will lead in turn to a significant replacement in the form of physical demand. This article also looks at the broader picture for banking in the light of the PRA's new regulations, as well as the specifics for precious metal derivatives. So let's now cut to a clip with Andrew Maguire.
Yeah, Shane, the window to comply and ditch these unallocated liabilities before they land on the balance sheet of these LBMA banks has already contracted, really. They've got 5 months left. And let's look, Mick, let's look at where we are in this process, because it is a process. And as we discussed last time, what the original LBMA begging letter essentially said was that the clearing banks would cease to operate if concessions were not made. However, that shot them in the foot because it drew attention, unwanted attention, to the sheer scale of hundreds of tons of high counterparty risk, unbacked gold credit transactions, which is all they are, settled amongst these members daily, weighed up against this tiny fraction of physical transactions underpinning these trades. So that was a price that they paid for trying to make this argument. And as we summed up last time, the process of deleveraging is well underway. And look, it cannot be reversed. And that does not stop the LPMCL from operating, though. It simply means that as of January 2022, they have to operate as a physical exchange with the liabilities passed on to clients. Go figure. That's how an exchange is supposed to function. Now, getting into the weeds, though, the LPMCL clearing banks must really, they're just going to act as a clearing member from here on. But it is important to understand these guys are not market makers. And I think this is where a lot of people are looking at it thinking they're market makers. They're not. It's their clients who are market makers. Now, obviously, this has been an incestuous relationship. That's been the historical problem, because obviously you've got the four banks that are still operating as the LPMCL members, but they also operate as market makers. So that's been as I say, an incestuous relationship. But there are governing regulatory factors that will ensure the deleveraging of the unallocated gold contracts will continue into the end of 2021. And look, and of course, this is nothing but bullish for the higher price of gold. And we've already seen that now with the refiners starting to pump up their physical prices based regardless of the spot gold price, which just been set again today. And what happens is it's just become a reference price. It's not the physical price as able to be delivered. So this is how it plays out from January, I think. Given the NSFRs are already influencing wholesale liquidity providers and refiner pricing, we think London will have to be compliant probably by late October, early November, not even till the end of the year. Now, if the LPMCL's clients, which are the market-making bullion banks and large traders, do not move to match these short-term deposits with long-term liabilities, meaning if they buy or sell unallocated gold by the end of the extension date into the end of the year, these transactions must be backed one-to-one by physical bullion, or they will have to roll the risk and associated haircuts onto their balance sheet. Well, compliance is not going to allow them to do that. However, if pooled or unallocated gold is matched with an equal number of ounces of physical, the transaction qualifies as Basel III compliant, and there is zero funding requirement. Of course, it won't be, even though it's unallocated and it's pooled, it'll be backed, and it will have to be. Otherwise, it rolls on the balance sheet. It's that simple. So the transaction simply flows through to the CME compliant physical exchanges where it is hedged. Now, if it's hedged, it's treated as a cash equivalent asset because it eliminates the price volatility. And this has already triggered a massive structural change in the behavior. And as unallocated open interest begins to reduce and fall and the overhead supply reduces, it will be a physical transaction that sets the global deliverable gold price. It's that simple. In other words, if physical gold is hedged, it removes the volatility risk and it qualifies to be treated as a high quality liquid asset. Now, the main point is that the COMEX is now compliant, but the over-the-counter markets are only just starting this process. They've got 5 more months to do it, but I think what we're saying is going to be a hell of a lot less than that. In fact, to buy a little time, we're aware that the key market-making banks on the COMEX have sneakily shifted their trading into London, and this means we must be a little patient, but we'll see a price rally extend into the end of the year. And obviously we know this because I think we've discussed this. UBS, for example, in Switzerland have reduced their traders down to 2 employees. Why is that? Because if you've got a physical desk and you're not trading paper and derivatives and forwards, you really don't need any more than 2 employees to handle the physical side of the transactions. Sneakily, these guys have moved themselves. All of the market makers have moved their operations into the hidden in the smoke and mirrors world of the over-the-counter markets. But we've just given you a reason as to why they don't have free reign.
So if the LBMA is solely to become a clearinghouse, the question is, well, what is a clearinghouse?
A clearinghouse is a third-party agency or separate entity that acts as a go-between for buyers and sellers in financial markets. The term is most often associated with commodity and futures markets. The clearinghouse is responsible for settling the exchange members' trade accounts, maintaining margin accounts, and collecting money. The clearinghouse also oversees delivery and reports trading data. Juanita sells 100 shares of ABC stock for $5,000 on an exchange. Daryl buys 100 shares of ABC stock for $5,000 on the same exchange. Daryl and Juanita never meet or know they were parties to the same transaction. Instead, the exchange's clearinghouse collects $5,000 from Daryl's account and places it into Juanita's account. At the same time, the clearinghouse makes sure the 100 shares of ABC are registered in Daryl's name. The clearinghouse also makes sure the trade information is reported to both parties and to the exchange. Clearinghouses make financial markets stable and efficient. With millions of trades every day, it would be very difficult for each buyer and seller to contact one another and settle the transaction on their own. However, a clearinghouse takes on significant risk that the buyer won't pay. The risk increases when people trade on margin. To mitigate this risk, clearinghouses require the exchange members to maintain minimum account balances.
So actually, to underscore what we're discussing, I got an email from a Swiss refiner, Arga Heraeus, on Friday. I'm going to read you an extract from that, and let me just grab this because it'll really demonstrate exactly what we're talking about here. And this is a letter. In essence, what this letter it kind of backs up and illustrates the evaporation of LBMA controlled paper market liquidity, and it's forcing premiums above spot, and it clearly reflects tight supply at spot generated prices. Now this is evidence of the physical dog beginning to slowly wag the paper tail, and we're only 1 month into this 6-month window. Now the essence of the letter notes that bullion, what it says is essentially bullion market conditions have recently changed. That's the essence of this letter. And let me just read it. And this is them. This is a Swiss refiner. The sourcing production of fine materials, 4-9s gold and silver in particular, they say, is getting more and more complex and expensive due to current market conditions, namely overall increase of costs in logistics, low-cost swaps, volatility, liquidity constraints, and so on. Therefore, we need to adjust our quotations accordingly. And they say this information also provided to adhere to to be compliant to the principles of transparency, fairness, as encouraged by our industry regulators. Well, I mean, this is exactly what we've been saying. There is going to have to be transparency, but that letter really is essentially what we're really saying is they then quote the wholesale prices above London spot price, fixed at the fix, as they have been, as every day the price is set at the fix. Now, the price rise above spot illustrates the unwind of paper gold liquidity, and that it's forcing the spot price to simply become a reference price for physical bullion. Now, this is the first sign that Basel III NSFRs that we've been discussing are beginning to impact global physical markets, and it's identifying the discrepancy between the spot-derived London fixed price, which has always been a paper price, and what is actually physically on offer. This is not going unnoticed by central banks competing for physical. So to answer your question, this is the battle we're seeing right now. Let's not forget that the physical gold market is not just siloed to just London and the US. There are military enemies at work here, such as Russia and China, and they lead a pack of other central banks seeking to secure and repatriate gold back to their respective currencies, right? So, I mean, even Brazil, in June they just reported, I mean, they purchased 41.8 tons in June alone, and this is just Brazil at an average price of about $1,820. Now, this is a central bank buying physical gold. There's a lot of competition. The point I'm trying to make, there is a ton of competition out there. And what Russia and China are reporting as accumulating is, in our view, nowhere near accurate, even though Russia, we know, has disclosed they're buying several hundred tons of gold. But essentially that, as we said last time, that's not from the market, probably that's going to be purchased internally, but restricts that supply coming into the market. But China, I mean, we know they are active, and we have lots of evidence they're active, and none of this is disclosed. But what this means is there are active physical buyers in the market ready to capitalize on any dislocation between the rigged spot price and the physical global markets. And that draws our attention to the exchange for physical mechanism and the need. Remember, we talked about this in March of 2020, and when it blew up. They need to avoid another March 2020 blow up, which when the dislocation between the spot price and the physical market actually imploded. And so really, just to sum it up, Shane, I think if we had to sum it up, the physically deliverable COMEX exchange must now reflect a deliverable global price, which means any gold futures backwardations have to be carefully managed. Not like before, and this puts a constraint on the LBMA banks that would like to ditch as many unallocated contracts as quickly as possible before these unallocated liabilities land on their books at the end of the year.
So when we look at the commitment of traders report ending August 2021, you can have a look here at the open interest short positions, the commercial players, and it is the lowest open short position, well, definitely over the last 12 months. So from about the 15th of June, I think it is, about 15th of June, since then we've seen the short positions basically unwind. And let's have a look at another article from Alasdair Macleod on goldmoney.com, dated the 5th of August, entitled The Extinction of Gold Derivatives. This month is the 50th anniversary of the Nixon shock, when the Bretton Woods Agreement was suspended and the expansion of commercial banking into credit for purely financial activities became central to the promotion of the dollar as the international replacement for gold. With the introduction of Basel III, commercial banking enters a new era of diminishing involvement in derivatives. The nominal value of all derivatives at the end of last year amounted to 7 times world GDP. While we can obsess about the effects on precious metals markets, they are just a very small part of the big Basel III picture. However, gold remains central to global money and credit, and the impact on gold markets should concern us all. In this article, I quantify gold forwards and futures derivatives to estimate the impact of reversing anti-gold policies that date back to the Nixon shock in 1971. We are considering nothing less than the effects of ending 50 years of gold price suppression. Through leases, swaps, and loan, central banks have fed physical bullion into derivatives markets from time to time to keep prices from rising and breaking the banks who are always short of synthetic gold to their customers. To summarize, bullion banks withdrawing from derivative markets is bound to create replacement demand for physical gold that can only drive up the price and further undermine fragile confidence in fiat currencies at a time of rapidly increasing monetary inflation. Now, let's have a look at the conclusion of this article. I'll put a link in the description. You can read the whole thing, but I just want to come to the conclusion of this article. So this month marks the 50th anniversary since the last vestiges of a gold standard for the US dollar were abandoned. We can surmise that it was by design that the banking reforms that followed in the 1980s contributed to the suppression of gold by expanding the availability of derivatives substituting for physical bullion, and it became central to the promotion of the dollar as gold's permanent monetary replacement. Today's policymakers repeatedly exhibit an ignorance of the underlying reasons behind the promotion of the dollar as the world's reserve currency. Now, I'm going to do a video after this where I believe we are seeing the beginning of the end of the petrodollar and the US dollar as the world's reserve currency. That's for the next video. Through the passage of time, they have probably come believe that gold has no future monetary role, and the few among the status who are alarmed by their addiction to monetary inflation probably think salvation lies in technology, digital currencies issued by central banks, cutting out credit creation by commercial banks to increase central banking control over money and credit. The escape route of digital currencies probably explains why reducing the role of commercial banks in financial markets by curtailing their derivative activities is not raising serious concerns at the central bank level, let alone over the likely impact on the gold price. We can only conclude that at the highest levels of government, the authorities are no longer concerned that a rising gold price is a challenge to fiat currencies and can be simply dismissed, in which case they will have underestimated the likely consequences of reversing a 50-year tide of gold suppression. So, what does any of this have to do with the World Economic Forum? Well, I did a little bit of homework and thought I'd have a look at what the World Economic Forum have to think about gold. So this is a clip from the first Basel III video I did earlier this year. Just watch this. All right, so here I'm getting to the good and bad news. So gold investors are likely to see a gradual phase of market prices for gold, which will delight the Russians, Chinese, and Indians, as well as, us investors. While Klaus and his mates at the WEF, IMF, BIS, and all the other globalists will accept this as a necessary prerequisite to ensure that the ECB not only survives, but that the digital euro, followed by other central bank digital currencies, are rolled out, which will help them implement their technocratic Great Reset program, which they've longed for. And so this is the bad news. And if you don't believe me, check out this article. Mark Carney, the former head of the Bank of England and the Canadian Central Bank, he even admits that it won't be pleasant. This new dystopia, this new technocratic Great Reset that he is now pushing like no tomorrow, along with his mate Klaus, in the name of climate alarmism. Am I allowed to say that? The tube's going to get me for that word. Anyway, who cares? I'll put a link in the description to this article. Read it. You can see it's dated 12th of June. So, this this is like a couple of days ago. That whole Great Reset, if you're unsure about, what that means, it just means, and Mark even says in this piece that he admits that we're going to have to give up freedoms. And so this is going to be good for gold investors because of the reset, in price. But they are doing it not to benefit gold and silver investors, not to benefit the retail precious metals investors. This is all about them getting their own way, creating their own dystopia, which I think is quite unpleasant. So let's not forget that Basel III was set up by the Basel Committee on Banking Supervision. By who? The Central Bank of Central Bankers, the Bank for International Settlements. Now, all these people, the World Economic Forum, the ECB, the IMF, all the central banks, they are pushing ahead with central bank digital currencies, whether we like it or not. That is their plan. They're moving forward with that. What have central banks been doing? Well, unlike that little video on the World Economic Forum's website, they did tell some truth in it, that it is recognized as global money. But they said that central banks have been selling gold. Well, as you know, if you've been following this channel, you'll know that actually central banks have been buying gold. And so the central banks, this whole central bank digital currencies, is something that I've looked at. One of the best debates on it that I heard was from an Australian guy, Rowan Gray, who's apparently advising the Fed. He did a 3-hour debate with Professor Bob Murphy on Bob Murphy's show, where basically he admitted commercial banks are evil. We don't care. We can get rid of commercial banks, and everyone can just have an account with the Fed. And using artificial intelligence, we can get around the whole socialist economic calculation problem that Mises talked about. And we can use real-time data to allocate resources, and so it's quite dystopian to think about it. But they're buying gold, so they don't care about the commercial banks. And so, JP Morgan, all these other banks. By the way, JP Morgan have unwound, from what I've seen, all their short positions. They're in a very good silver position, JP Morgan, but they don't care about the commercial banking operations. In fact, by negative interest rates, all this stuff, this hurts commercial banks. We are moving to a new system, central planning with central bank digital currencies. And central banks are the ones that are buying gold. They don't care about the paper market. At some point, the paper, gold and silver market is going to blow up, and they won't care. They're the ones holding the physical. They're the largest holders of the physical gold. So, look, from that point of view, that's one argument to own gold and silver, because they own it. And they don't care about the commercial banks. They don't care about you and I either. But I also believe, just on the fundamentals, whether it's the monetary inflation is going to continue. And in fact, if we get central bank digital currencies soon, that's only going to increase, because they can create even new currency and send it directly to people's back pockets or in their phones. So you don't have to go through the commercial banks. Create bank reserves and then hope that the banks create new loans and loan into existence new currency. They can do it themselves at the click of a button. And that's going to be inflationary. UBI, MMT, UBI, sit at home. Don't worry, we'll create more currency. The West have completely lost their minds. And that, I don't want to get off topic. But I see an inflationary decade ahead. And that is the number one reason for me to own gold and silver. Second is we're going to see financial chaos. That's number 2 reason to own gold and silver. Number 3, the fundamentals. We're moving to a so-called green economy where we're going to have a demand for commodities, and silver is one of those. And so the demand on the industrial side is only going to increase. And that's going to create more demand. And then, you can go down this rabbit hole, which I've been doing. So there's a bunch of reasons to own gold and silver. Anyway, What do you guys think? You think I'm a crazy nutter? Do you guys think that this all makes sense? What do you guys think? Love to see your thoughts and opinions in the comments below. Don't forget to hit that like button if you like this video. Really do appreciate it, guys. If you haven't subscribed, do so. Hit that notification bell. Take care, everyone, and I'll see you again on another episode of Finance Uncut.